Hi, my name is Vijay Angelo, the CEO of Inspira Wealth. Welcome to our first roundtable, what I hope will be a series of many. For those of you who don't know us, Inspira Wealth is a relatively new digital wealth and asset manager. The team behind it have been in the markets, both in traditional finance and crypto and digital assets for many years. All of us very enthused by innovative approaches to financial markets, to wealth management, wealth growth and wealth creation. Today's panel is based around, well, the first stage of are we facing a recession? What's happening in the crypto market in a recession, and can digital and digitisation help at all in that market? The panelists sit on both sides of the fence, both crypto and traditional finance. We're really excited about a lot of the comments and theories and ideas they have about where we're going, how we can get there, and how we can help either protect our wealth in a downturn, increase our wealth. I hope you'll enjoy what we're going to present to you, and looking forward to bringing more to you in the future.
My name is Konstantin Shulga. I'm the CEO and co-founder of Finery Markets, a marketplace for institutions accessing digital asset space.
I'm Francesco Romano, Head of Risk and Quant at Tabula Investment Manager.
Luke Hickmore, Aberdeen, Investment Director in our fixed interest credit team.
My name is Sarah Young and I am a Sales Director for the UK and Ireland at Kaiko, which is a digital assets market data company. So we are bridging the gap between traditional and digital finance.
My name is Nick Harrington. I'm CEO of the Eximius Group.
As you saw from the introductions of the first Inspira Wealth panel, and you've met the panelists earlier on, the first topic we want to get into is, are we heading for a recession? And most people think they are. And are we there already? I'm going to start with Luke Hickmore from Aberdeen, who's going to tell us exactly what he thinks, and then we'll go from there.
Are we going into a recession? Well, I think depending on the salary you earn at the moment, you feel you're in a recession. If you're in a lower income quartile or even medium income quartile, I think across Europe, the UK and much of the USA, you feel you are in a recessional moment. The fact that the National Bureau of Economic Research has said 2 quarters of recession is no longer a recession, I think is a bit of a red herring. We're there now. I think Bailey at the Bank of England's been very clear with their forecast of a 2% recession over 5 quarters starting in Q4 2022. That's a big call for a central bank who's hiking interest rates into that recession. So it's not going to be pleasant. We know we're there. Who comes out of this well, who comes out of it badly, is going to make a massive difference for almost every single asset class, whether we're talking virtual or whether we're talking physical. And I think the savers and investors today need to be thinking about diversification, need to be thinking about not getting too close to the consumer with their investments. They need to be thinking about long-term margins in companies and who can defend them. And I think you could come out of the next couple of years actually okay, which is a pretty unusual thing to say during a recession. But you know, we're there now. It's going to get worse. That's not a particularly upbeat message, but as a fixed income investor, that's not too bad either. I mean, you know, you could get some decent yields, and that helps to compete across the asset classes as well.
So you guys were chatting a bit earlier as we were sitting outside, Francesco. I mean, you're in fixed income as well, and interest rates. I mean, we haven't seen such rapid raises in interest rates since the early 90s. Where do they stop?
I think that we can all agree on the point that this really depends on which of the main developed economies we're looking at, or if you're looking just at developed economies. There's a big gap in timing, and someone might even say there is a big gap in objective between the US, UK, Europe, Japan, and emerging markets. And we are going to see very different results. What is very clear that a big part of this inflation, particularly in Europe, is not core-driven and cannot be impacted by interest rate hikes unless a big recession is triggered by them.
So it's not monetary inflation, it's a real asset inflation problem, isn't it? It's a supply chain inflation.
It's a supply chain, is a geopolitical decoupling inflation, I cannot increase manufacturing in Asia anymore, inflation is probably we are not going to be friends with huge parts of the world inflation, and this is inflationary. Usually it also beats recessions. So what we're looking, if you look at just, I don't know, we're on Bloomberg, as I like to say, if you look at how the market's price, we see rate cuts, maybe even just not just in the US, but probably even in the UK and maybe in Europe, but that's much less probable, just around the corner next year. And this looks as doom and gloom predictions. What we look at the moment, I think it's very interesting, is what's happening in China on the other way, the other side. So we're seeing some slightly dovish policies to work around the zero COVID policies and the ramp up of pressure on real estate names with the lead lines last year and on tech names with all the regulation. And this is decoupling in monetary policy as well is where I think we should focus, because it's the factory of the world, it still is 16% of the world exports. And inflation is driven also by what happens with the yuan, not just what happens with the dollar. We are very dollar focused because of energy at the moment. But all of us speak about that, but I think we should speak about that as well.
So the interesting question is basically, here's one. Actually, most of you won't remember it. Who remembers the last time we had massive double-digit inflation? Well, not quite double-digit inflation, but mortgage rates at 10, 12, 13, 14%. Is it? Okay, there's just three of us. That's depressing.
Negative equity.
Yeah, people handing the keys in at the real estate agent driving off. Are we going to see that again?
Kind of people have been looking at trying to think about what now looks like in the past, right? And 70s comes up again and again. And we heard 24-25% inflation in the 70s. We had 2 oil crises. We had a 3-day week. I mean, it was a disaster. It's not then. It's really not then. And I think, I think we probably agree on this, that pace now is actually really important too. So the pace we went through COVID, what happened to the economy during COVID, the speed of cycle at the moment is something we've never seen before. And I think we see that both in terms of speed of rate rises, how soon the plateau happens, and I agree with you, how quickly we come down the other side. So, you could easily hit 3.5 in the US, really easily hit 3.5, but don't be surprised if that's March, right? And then you plateau and start coming back down the other side. So we go through September and into Q3, Q4 2023. So that's very different.
Yeah,
right? And I think it's tempting to look back and think, this feels like 1994 or Black Wednesday or Black Monday or Nick Leeson or something's happening, right? That you've got a name to it. But I think it's actually a pretty unique period that we are, that's caused all these issues and has caused the pace that we're going to go through.
So are we basically in a slightly faster moving, but not entirely, we're not in a crash, we're in a slow to fast moving car crash that we're in right now. We're not going to have another red October as we've had so many decades in the past with a big crash. And Constantine, you run a liquidity firm, a market making firm. You must be seeing a lot of different activity on the exchanges you're involved with.
Well, actually, yeah, so we at Finance Markets, we run a marketplace where we connect multiple liquidity providers around the world, and I think from the world economy perspective, we'll see more surprises from some frontier and emerging countries, and especially with the depreciation of their local currencies. We see I'll give you one example. When the Turkish lira was depreciating over the last year and actually this year, those days were one of the best days for some largest crypto exchanges for the new clients coming and trying to save their funds. So it actually that's an interesting I would say story behind that, because all of the local population from those countries, they're trying to escape and actually depreciate the value of the local currencies even more. And that's actually pegging into some stable coins. So that's that's one of the interesting trends to see there. So I think there'll be more and more surprises there.
Are you seeing liquidity drop off in a lot of these exchanges? We keep hearing stories of 80 to 90% drop off in crypto exchanges liquidity.
Well, actually, it's a good point because most of the volume across hundreds of those smaller crypto exchanges is mainly 80% wash trading. That's what it can be debated, but the world probably does not need 1,000 different crypto exchanges, and crypto right now is the most fragmented asset class. So probably you are the data specialist. You can also mention what are your ideas about the wash trading in the current markets. But for sure, most of those volumes are just not real. So there is not a real liquidity.
If you look at how many currencies there are, there's 20,000 currencies, there's 500 exchanges versus what is about 160 plus national currencies. So we're dealing with something completely different here. What we're seeing, the demand for derivatives trading, that's really where the volume is at the moment and where it's grown. So, and certainly, we're a company that's been around for a long time, but certainly, well, relatively long time in, I guess, the crypto world. But where we're seeing new interest in terms of what we provide, which is essentially market data, bringing all of the centralised, decentralised exchange data together, is that demand for on the derivatives side. Spot is obviously still important as well, but really derivatives as well.
So just bring it back to the economy again for a second. And one of the interesting parallels I had a conversation, we'll come back to crypto in more specific terms in a minute, was when we looked at all the causes of various crashes over the last 20 or 30 years, going back to the oil crisis, we've got one. We go back to monetary inflation, which we had in the 80s twice. We had a geopolitical crisis at the back end of the 80s, early 90s with the Gulf War I. Of course, another oil crisis, we've got that as well. We go back into the late 90s, we had emerging market crises, we had China, we had Russia, we've got those again. We add in supply chain issues, and the conviction you had a few minutes ago about this is not going to be a long run thing. Are you not concerned that perhaps we're underestimating the situation? Certainly you mentioned China, which I think is a huge problem. The property market's collapsing. We saw a run on a Chinese bank outside China the first time ever because you couldn't actually get your cash out in China. We saw the Bank of China and Australia have a run there. Do we think there's something which may trigger a bigger, is Michael Barry right, we're only halfway there and we've got another big crash to go?
Let's go back even further. Let's go back to the 1720 South Sea bubble.
I was going to say the big one.
And every single banking and financial crisis that's happened since, right up to the GFC, is caused by over-leverage, and it's caused by over-leverage typically in the banking sector. That's not where we are. Right? Banks are actually in one of the healthiest positions I've seen them in the 35 years I've been in this industry, coming into what could be a nasty recession or a shallow recession, who knows, but a recession. That's not a bad place to be. This isn't crisis territory. Now that could come from China, it could come from Chinese property market, but even today they've announced massive stimulus for the Chinese property market, and suddenly bonds are ramping 20 points. So it could come from that direction, but I think we all forget advanced economies where we live versus developing economies who have been learning from all our mistakes for the last 302 years. Doesn't mean they can't make them again, but they make them differently and probably with less impact than it has been for a long, long time. And we just need to remember how much treasuries China's got, right? It makes the Russian situation with their reserves look like a walk in the park. So it's in nobody's interests to make that difficult, make that into a cause célèbre or China pushing on a button. I don't think this turns into a situation where you have a rolling crisis that rolls into bank failures, that rolls into swathes of the population facing really hard times like the 1930s. Right? That this is in some ways a bog standard recession. That it hurts parts of the population and not other parts of the population. The unusual bits, as I've said, is that employment remains pretty good through it. Banks are in healthy shape. Corporates are in amazing shape coming into this recession. Governments,
not so good.
just print it's a magic honey tree. It's not. It's
Here
not
comes
that
more
bad.
quantitative easing.
So no, I don't think this rolls into a global crisis.
So that brings up an interesting point. There was a load of articles this morning in quite a few of the papers about the beginnings of winding down employment, number of job vacancies decreasing, or increasing, I should say. But it still seems like a reasonably healthy employment market in comparison with normal times.
It's super healthy, and if you move in the last 18 months, you've had an average of a 30% uptick as well. So people are enjoying the fruits of actually moving. They've got more spending. Yes, inflation's hitting them. This is across professional services predominantly. But when I go and speak to friends and colleagues in other sectors, it's pretty much across the board an uptick. I think you're finding it painful if you have stayed put, been loyal, and not been rewarded from that sort of period of time. But the inflows are still coming in. And I think the volatility in the market, financial markets, meant that investment banks actually made money. They're no longer relying on the retail arms. You saw hedge funds, a couple went pop through over leverage, as you mentioned, but the majority of them have had record upon record years going through this and have been growing and scaling. Real estate investment funds have got even bigger. The way real estate as an asset is viewed in the States is totally changed now from what you're seeing across BlackRock, and people there have actually seen that as Blackstone as an actual asset to buy and purchase for long term to take them on the market. It's been a rapid expansion, and to the point now where they've hit a bit of a talent wall, where the best people have sort of moved in the market, how the prices are going up and up on that sort of talent war. So as much as we don't expect it to stay at this rate, because it's just incredible the rate it is, but we'd expect it to sort of plateau, or for firms frankly getting much more aggressive on buybacks, or seeing salaries continue to jump higher and higher and higher.
So the interesting thing there is, how does that play into an inflationary cycle? If we're going to see a shortage of, and how much Brexit's playing into that, so we're going to see a shortage of staff and salaries continue to push up. Where you talk about the bottom end, where the real pain is being felt. In real terms, salaries are going up, even though they're going up 4, 5, 6%. That's a negative salary increase of 5, 6% for the bottom end, whereas you're saying you're seeing 20, 30% increases at the top end.
Yeah, easy, and on certain jobs where we can't even fathom why someone would get paid.
So the wealth gap's increasing.
Yes,
dramatically.
It has been since the GFC.
Yeah, and it's about to take another substantial leap, or is in the process of taking another substantial leap. All right, so if it is increasing, what advice could we give to people in that bottom end who are struggling, if they've got any spare cash, any kind of way of either insulating themselves or finding a way to sort of dig themselves out of it? So that cycle could last, that gap cycle could last 3-4 years, typically, before it filters through to the bottom end of the market. So what could they potentially do?
I think that's a political question, DJ. I think there's very, very little they can do, and they're really relying on bailouts, and that money doesn't come from nowhere. And you've also got, I live in Scotland. My marginal income tax is 53%. That's getting up there. We saw 90% in the 70s and a massive brain drain.
I remember when Thatcher cut it from 90 to 60 and people were dancing in the streets.
So,
God,
this is an intractable problem, but it's a political problem.
Yep.
And this is the issue that people need to rely on politicians, who become very difficult to rely on. But the whole wage price spiral thing isn't happening. We had yesterday the wage data out of the US with a record -3% wage increase in real terms. Yes. And it's showing you actually companies are keeping on top of this. And that's so important, because as inflation spikes, as we will, and maybe up to a 13% kind of number, as suggested by the Bank of England in the autumn, ouch. Not everybody's facing that same inflation rate for a start, by the way. So, it's not, as always, detail on this is so important. But okay, let's use 13%. For companies, that's a really good nominal increase in their revenues. That it's high single digits. They keep a top on their costs, both wages and input costs over the next year. They're in a good place. Problem actually comes when inflation comes down. Then you get margins get squeezed. You've still got the pressure of the wages coming through from the last 2-3 years, which could last, as you say, for another 2-3 years. I'm not scared about a recession next year, because of the setup into it. It's pretty good for the economy and companies and individuals and banks. 2024, 2025, I'm actually a little bit more concerned for profitability for companies and how that comes through in terms of equity markets as well.
Which, not without getting too technical, there's some really weird yield curves out there.
Yes,
they're not curves, they're waves. I haven't looked at it for a few days, but I think we're negative at the back end of the curve in sterling and massive positive at the front and I don't think I've ever seen a yield curve like that.
1990s.
Oh no, you're right actually. Yeah.
Inverted yield curve for most of the 1990s.
Yeah, it didn't.
Some pretty flat CDS spreads
Yeah.
as well, which is like quite surprising, going back to the start of the market as well. So it's like very interesting. And on the curve point of view, I think there is a very interesting point, which is the US 10-year break-even. Currently reads at 2.44%. I'm not sure anybody at this table thinks that the average inflation rate, more or less, in the next 10 years in the US, which has such a relatively strong economy, and with all this pressure, geopolitical, historical, demographic we spoke about, is going to stay around that number. Considering in the 10 years before, it stayed at 2.33, which is more or less the same. I think that we are seeing some interesting mispricings in the curves, while, as we said, like the short end is dominated by the central banks. Of course, it's a little bit more predictable at the moment, but the long end is like showing, as you said, some very strange shapes and maybe some strange values as well.
So just getting into the final piece on the economy, property market, it's always the place where everybody goes. So according to statistics in the UK at least, 40% of the fixed rate mortgages out there are 2-year fixed that got nailed down during COVID. So that means 40% people coming out of a 0.1, 0.2% base rate mortgage during COVID to a 1 3/4, maybe even 2.5%, 3%, 3.5%. I'm going up, just not fast enough. Fixed rate into floating rate mortgages, they're not going to be able to remortgage very easily. The property market, is it going to keep going? Have we got a little bit of a downturn? Constantine?
Yeah, actually, also going back to your previous question, so that will also not help like the average like man, like a woman, in order to increase like that disparity of wealth. And one point that is important to make here is the crypto or like the digital assets were playing an important role here because during the COVID times there was a lot of like helicopter cash spread across the countries, and the people were just leaving their jobs and trying to invest into crypto, trying to shorten that disparity by just saving and having this easy money that they think they can earn on crypto. And I think that would help like the whole crypto industry to grow. But after all of those like collapses, after the correction, most of those like people were just quite disappointed with the like industry in a whole. So that's I think that will be harder for a next like crypto spring to emerge when you have like millions of people kind of disappointed about what happened there. And also like the advice that we can give to those people, it's what they should not do is just sort of should not bet all of their savings and in the anticipation of some easy cash that they can just invest in multiple 10 times or 100 times buying Bitcoin or Shiba Inu. That's
Dogecoin, come on, tell me Dogecoin.
Exactly.
But just out of curiosity, who here is actually actively investing in crypto?
Yeah.
You?
Not for clients.
Yeah, quick comment there. Yeah. So we all are in some form or another.
But I think for the younger generation, it goes back to, I mean, there isn't any financial education at school. There never really has been. And that, it's just, well, you can now see that it's come home to roost.
It's interesting actually, even for people in their 20s, I've discovered not a huge amount of strong financial education at all. But then you get the attraction of crypto because it's bright, it's shiny, and it's got lots of colours and what have you, and it goes up.
And this financial education has been replaced mostly by YouTube, you can say, right?
Yeah.
And actually, this very good material on YouTube.
Yeah.
Hopefully, this is going on YouTube, right?
Yeah, it's going on YouTube.
Very good material,
Yeah.
as I said. And my point there is, a lot of these people were pushing crypto at the same time, you remember?
Yeah.
And so there was also this game a little bit. But I think for those who invested, mostly because they were interesting on the network effect, and they took the time to read their white papers, and they put the amount of money they were okay with losing, I think there are no big problems at the moment. There is a huge part of the IT community, for example, that became very passionate about that, and there are millions of people. Probably are not those that struggle so much with this cost of living crisis, given the increase in jobs in IT, for example. But the point about financial education is so important connected to crypto, because we will need probably some, maybe not some crypto education, but at least some markets, so and some systems education for people to know what they are buying.
And regulation.
Yeah,
Regulation, yeah.
It's
Yeah.
still a wild, wild
When you
west.
buy a stock, maybe you don't know anything about depositories, a settlement, but you have a marginal idea, I like to say, that you are entitled to some dividends maybe, or that maybe there is a share buyback, and in general, this is a piece of a business. When you buy one Ethereum, you spend $2,000 more or less at the moment, and what you get? You get fuel for machines on a distributed network that is secure and can be used to transmit information and stuff like that. So it's a commodity potentially. I see it like that. I see it as industrial metal, let's say, or oil of the internet. But you have to understand this a little bit more in detail because we know companies, we interact with them every day. You don't interact with these things. And we see a lot of people buying on a centralized exchange, leave the money there, never interact with the smart contract. That's very, very risky, of course.
When you say, I mean, that has been the vast majority of crypto players, though. So most of the people here on the table are reasonably educated.
Yes.
I'm excluding myself here. Investors and players in the market. So I'd say most of you have read a white paper on anything you've bought. 80% of investors in crypto, I would say, probably
I think 95.
probably knew there was a white paper there somewhere and just went and bought it, which creates an interesting dynamic. It is a sheep herd mentality for any drive in the market. And right now, crypto markets I wouldn't say it's in real trouble, but it's in a spot of bother. Guys, thank you very much for coming along. I hope you enjoyed it, had a lot of fun, and look forward to catching up with you all soon.
I thought that was really interesting. I learned a lot about how crypto is going to change over the next 5-10 years, maybe a lot quicker. A really good discussion around how the economy is going to survive over the next 2 or 3 years, and perhaps, really importantly, how much education there is still to be seen by the wider populace to get crypto into their portfolios.
Well, first of all, I really enjoyed the conversation. Great people that Inspira Wealth and Vijay were able to bring together. So probably on the insights, there are two. One is the good news, the recession is it's still there for quite a while, but it's not that deep. So that's a good one. And still, there is a lot more to learn about the crypto space. So I think that's also the main takeaway of the lunch.
Today was great. It was wonderful to hear so many different views and opinions from the panel. We're all from slightly different backgrounds and slightly more progressed from like traditional and Web3 backgrounds, and hearing that sort of cross-section of thoughts was great.
It was really interesting, having not really met any of the other panellists. I think just hearing a different perspective from someone in the TradFi space, through someone that owns an exchange, and just getting everyone's perspective on what they're seeing at the moment from a sort of macro perspective.
It was extremely interesting, in particular, to meet people from different parts of the industry, coming from recruitment and venture capital up to market data, market makers, and funds and ETFs. This altogether gave us a broader and more holistic approach to the topic of cryptos in these current market conditions.
I found today really useful, lots of fun, great panel, good bunch of guys and girls who had a lot of interesting thoughts and opinions on different aspects of what we wanted to talk about. What we aimed for, which was something educational, was great. It was probably a little bit heavy on the business side at the beginning, but hopefully that will inspire people to think about what they're doing in terms of investment, crypto, recession, all that sort of thing. So I think it was a lot of fun. It was interesting, but hopefully educational, and people enjoy it.